Hey everyone, and welcome back to the channel. Today, we're diving deep into something that can truly transform your trading game: chart patterns. I know, when you first look at a trading chart, it can seem like a jumble of chaotic lines. But what if I told you that within that chaos, there are recurring shapes and patterns that can signal where the market might be heading next? Stick with me, because by the end of this video, you'll be able to spot these patterns and use them to make smarter entry and exit decisions. So, what exactly are chart patterns? Think of them as the market's body language. They are graphical formations on a price chart that are created by the movement of asset prices. For decades, traders have noticed that certain patterns tend to repeat themselves over and over again, often leading to predictable outcomes. They reflect the psychology of the market, the constant tug-of-war between buyers and sellers. By learning to read these patterns, you're essentially getting a sneak peek into the collective mindset of all market participants. Let's start with one of the most fundamental groups: reversal patterns. As the name suggests, these patterns signal that a current trend is losing steam and is likely to change direction. One of the most famous reversal patterns is the head and shoulders. Imagine a peak, which we call the left shoulder, followed by a higher peak, the head, and then a lower peak, the right shoulder. These three peaks are all connected by a support level called the neckline. When you see a head and shoulders pattern forming at the top of an uptrend, it's a strong bearish signal. It tells you that the buyers are getting exhausted. The initial push-up forms the left shoulder. Then they try one more time, pushing the price even higher to form the head, but they can't sustain it. The sellers step in, push it back down to the neckline, and the buyer's final, weaker attempt forms the right shoulder. The crucial moment is when the price breaks below that neckline. For many traders, this is the confirmation they need. It's their signal to consider entering a short position or exiting a long one. The entry point is right after the break of the neckline, and for an exit or a stop loss, a common strategy is to place it just above the right shoulder. The opposite of this is the inverse head and shoulders. It looks like an upside-down version and typically forms at the end of a downtrend. You'll see a trough, a lower trough, and then a higher trough. This pattern is a bullish signal, suggesting the sellers are running out of power and the buyers are starting to take control. When the price breaks above the neckline, it's a potential entry point for a long position. You place your stop loss just below the right shoulder to manage your risk. Another classic pair of reversal patterns are double tops and double bottoms. A double top looks like the letter M. It happens when the price hits a resistance level, pulls back, and then tries to break that same resistance level again, but fails. This second failure to push higher is a strong indication that the buying pressure is fading. The entry for a short position is typically when the price breaks below the support level formed between the two peaks. A double bottom, on the other hand, looks like the letter W and forms at the end of a downtrend. It signals a potential upward reversal. The price finds a support level, bounces up, comes back down to test that same support level again, and finds strength. The entry for a long position is when the price breaks above the resistance level between the two bottoms. Now, let's talk about continuation patterns. Unlike reversal patterns, these suggest that the market is just taking a brief pause before continuing in its original direction. They represent periods of consolidation before the next big move. Think of them as a coffee break in the middle of a marathon. A very common type of continuation pattern is the flag or pennant. Imagine a strong, sharp price move, either up or down. This move is called the flagpole. Following this flagpole, the price starts to consolidate within a small, rectangular channel that slopes against the prevailing trend. This is the flag. If the consolidation happens within a small, symmetrical triangle, it's called a pennant. These patterns show a temporary balance between buyers and sellers before the dominant group reasserts its control. So, how do you trade them? If you spot a bullish flag or pennant in an uptrend, your entry point would be when the price breaks out above the upper boundary of the consolidation pattern. The idea is to catch the next leg of the upward move. Conversely, in a downtrend, you'd look for a bearish flag or pennant. The entry for a short position would be when the price breaks below the lower boundary of the consolidation. These patterns are powerful because they allow you to join a trend that has already shown its strength. Another important group of continuation patterns are triangles. There are three main types: symmetrical, ascending, and descending. A symmetrical triangle is formed when two trend lines converge towards each other. The upper trend line is descending, and the lower trend line is ascending. This pattern indicates indecision in the market, but it typically resolves with a breakout in the direction of the original trend. So, you wait for the price to break out of the triangle before making a move. An ascending triangle is a bullish pattern. It has a flat horizontal resistance line at the top and a rising trend line at the bottom. This tells you that while sellers are holding the line at a certain price, buyers are progressively more aggressive, making higher lows. It's like they're knocking on the door, and eventually, that door is likely to break open to the upside. The entry point is the breakout above the flat resistance. A descending triangle is the bearish opposite. It has a flat horizontal support line at the bottom and a descending trend line at the top. Here, buyers are holding a certain support level, but sellers are becoming more aggressive, creating lower highs. This pressure from above often leads to a breakdown below the support level, signaling a continuation of the downtrend. The entry is the breakdown below that flat support. Now, identifying these patterns is one thing, but acting on them effectively is another. First rule: always wait for confirmation. A pattern incomplete until the breakout or breakdown occurs. Jumping in too early, anticipating the move, is a recipe for getting caught in a false signal or a fake out. For example, with a head and shoulders, you must wait for the price to close decisively below the neckline. Don't just act on an intraday dip. Second, always use stop losses. Trading is about managing risk, not predicting the future with 100% certainty. No pattern is foolproof. A stop loss is your safety net. As we discussed, for a head and shoulders, placing it above the right shoulder is a good strategy. For a flag pattern, you might place it just inside the flag on the opposite side of your entry. This ensures that if the pattern fails, your losses are contained and you can live to trade another day. Third, consider using volume as a confirmation tool. A genuine breakout or breakdown should ideally be accompanied by a significant increase in trading volume. High volume on a breakout shows strong conviction from the market participants and makes the pattern more reliable. If a price breaks out of a pattern on very low volume, be cautious. It might be a weak move that could easily reverse. Let's put it all together with an example. Say you're watching a stock that's been in a strong uptrend. Suddenly, you notice it's starting to form what looks like an ascending triangle. You see a clear horizontal resistance line where the price has been rejected multiple times, and you can draw a rising trend line connecting the recent lows. You keep watching. You don't do anything yet. You wait for the confirmation. Then, you see a big green candle push through that resistance level, and you check the volume indicator it's spiking. This is your high probability entry signal. You could enter a long position here, place your stop loss just below the rising trend line, and set a profit target based on the height of the triangle. Mastering chart patterns takes practice. It's a skill. So my advice to you is to open up your charting software and start looking for them. Go back in time on your favorite stocks or assets and see if you can spot these patterns and how they played out. This practice, known as backtesting, will build your confidence and train your eyes to recognize these formations in real time. Don't rush to trade real money. Start with paper trading to test your strategies without any risk. Remember, chart patterns are not a crystal ball, but they are an incredibly valuable tool in a trader's toolkit. They provide a framework for understanding market structure and identifying potential opportunities with a favorable risk-to-reward ratio. When you combine pattern recognition with solid risk management and other forms of analysis, you put the odds firmly in your favor. That's all for today's deep dive into chart patterns. I hope you found this breakdown helpful and that you feel more confident about reading the language of the market. If you got value from this video, please hit that like button. It really helps the channel out. And if you haven't already, make sure to subscribe and turn on notifications so you don't miss our next video. Drop a comment below and let me know which chart pattern is your favorite to trade. Thanks for watching, and I'll see you in the next one.